Hello and welcome. You're watching MF Corner. I'm Sumaira Abdi. Now on the show today, Prableen Bajpai, founder of FinFix Research, is going to talk about what is the current status of the segregated units. Also later in the show, we'll have Mohit Gang of Moneyfront joining in to talk about what should DIY investors watch out for, particularly whether you're being sold regular plans or direct plans. So first, let's focus on what is the status of the segregated portfolios, because a lot of investors have reached out to me trying to figure out what is the current status of their investments which are held in side pockets. And side pockets, you'd remember, is if there's a default or something becomes illiquid, mutual funds now have the ability to create a separate bucket for it, right, which is what we call the side pocket or the segregated portfolio, which has its own NAV, and if and when there is some recovery, so they pay out from that, right? So that is essentially what it is. Now, I was shocked to discover that at the end of July, there were 800 crores odd, which was still remaining in various side pockets. That's why I thought it would be a good idea to invite Prableen Bajpai, founder of FinFix Research, to give us a sense of where this money is lying and what is the current hope of recovery. So Prableen, good afternoon, and thank you very much for joining in. So first, I want to ask you that, where is the largest concentration of side pockets, in terms of categories of mutual funds or schemes themselves, and which are these the top accounts here?
Right. Good afternoon, Sumaira. Great to be on this show. So, Sumaira, as per the AMFI data, we have about 800 odd crores, the figure that you mentioned. But, I'd like to add here, Sumaira, that this actually is not a true representation of how much money is actually segregated. Because this is actually now the current market value after all the markdowns which was done by the schemes, and many of the segregated portfolios are actually even marked down to zero. So let's say 81 bond which had an exposure, for example, a Reliance exposure of 800 crores is now marked down to zero. Or Vodafone, which actually had an exposure of 600 crores, particular scheme, is actually now just showing at 1/4 of that face value, the exposure. So this is actually not a very true representation. But and another thing I like to add here, Sumaira, that one episode of default like the DHFL is actually was found across 24 AMCs, were victim of it. They had exposures to that particular company with about 165 mutual funds, having that exposure. But when we're talking about these segregated portfolios, these are just across 7 fund houses, and that too limited to about 5 to 7 categories overall.
Okay, understood. So, it depends on exactly what is the instrument that the scheme might have invested in, and therefore the side pocket relates to that particular instrument, right? Probably let's talk of some of the big accounts, and a lot of viewers are also familiar with it. One, of course, is Voda Idea, which still remains in the side pocket, but here I believe is the highest hope of a recovery.
Right. Voda Idea, Sumaira, had 2 papers. One was due in July 2020, for which all the principal as well as the interest amounts has been paid. Now, the second one is due in September of 2023. And now this is currently having a credit rating of CARE B+. B+ is below the investment grade, and that is why it has been side pocketed. About 140 crores is reflected as per these segregated portfolios. But again, 4 out of those schemes, which are Franklin, had downgraded and marked it down to zero. Reliance and UTI, their exposures are also at just 25%. So the overall amount is more. But yes, I think there's a fair chance of this coming back. First, I think the first point here is because now Vodafone can actually repay the AGR dues, over the next 10 years. So that's some relief for them. Secondly, the company is also looking to raise about 25,000 crores. A lot of obstacles in the way, but that's their plan. And the third thing is that they have not, till now, they have serviced all their interest as well as principal payments, which were due in June 2020, July 2020, January 21, as well as February 22. So, Sumaira, while they posted losses of about 44,000 crores in FY21, I think there is still a fair chance of this money coming back.
Okay, so we hold out for Voda Idea. What about Yes Bank? Because this was another case of a massive heartburn, and especially those who were directly invested into the 81 bonds, right? So I know there's a case ongoing in the Bombay High Court. Can you take us through what's the latest there?
Yes. So, Sumaira, about 8,415 crores is stuck here. And of course, when the restructuring happened in 2020, the RBI invoked the Section 45, as per which the whatever 81 exposure was there, it had to be marked down to zero. So across all segregated portfolios, now this is showing at zero, the current value. And of course, the case is going on. The last one being where the hearing was in July, and but there is nothing substantial, Sumaira, which has come here. One thing is that the Yes Bank infrastructure bonds have been now upgraded to infrastructure grade. But of course, because the matter is in the judiciary, and I think it's going to be a long and a painful wait for the final outcome here. But we can only hope for the best. But I would say that the markdowns have already taken place, so investors have taken a hit. So if it comes back, it's going to be a bonus. But I have low hopes here.
Okay. Now, let's come to that famous standstill agreement that happened. And everybody who had heard about it had possibly heard of, till then, what was a little-known company, Adilink, right? Any scope of recovery there?
Adilink, Infra, and Multi-Trading, of course, it was promoted by the SL Group. And very interestingly, Sumaira, 98, almost 99% of their exposure was actually to only Aditya Birla and 3 of their schemes. Now, the payment for this particular, the NCD was actually due in March of 2020, but in November, they marked it down. So they valued the holdings at 65%, and then it was segregated later. So out of this whole data, the SEBI data, which shows about 800 crores, 600 crores is actually in Adilink. So that's because the downgrade was not done, like it's at 65% valuation. And yes, Sumaira, I think there's a good chance of this coming back. But I think 2 things here. Firstly, that the mutual fund house actually has the road projects as the pledge which this company had given. So they will be monetizing by selling out those projects. But I think it's going to be a little long drawn process, given that it's unlisted infrastructure assets, and we've been through a phase of lockdown. So there is a fair chance of this money coming back. That is what third-party agencies have been saying, that if they're able to sell it successfully, the whole money can be recovered. But I think we'll have to wait here for how this process actually finally ends.
Okay.
And when.
So I have a couple more names that I want to go through quickly. The big one, of course, is also DHFL.
Yeah. Divan Housing, Sumaira, now this, as I just mentioned, that 165 schemes actually had exposure, and some of them directly just took a hit. So it was not segregated because the segregation process was just.
They didn't have it then, yeah.
Yeah, it was actually announced, but it wasn't properly structured then. So Tata Mutual Fund was the first fund house actually to go in for a segregation within the mutual fund industry, and it was done for DHFL only by them. And currently, out of all the segregated portfolios, only Tata has an exposure in a side pocketed for DHFL. Now, this one, Sumaira, Pyramid Group will be taking over this company. The whole plan has been, it's finalized. But it has a debt burden of about 87,000 crores. And out of which Pyramid will be giving them about 37,000 crores, which means that the money can come back to investors, but only part payment. Out of the 37,000 crore, about 12,000 is going to be paid directly. About 3,000 crores has been kept as interest payments, and about 20,000 crores, Sumaira, has been kept for the payment of NCDs over the next 10 years. So definitely individual investors, mutual funds and banks all have been lenders to this group, and only a part payment is going to come back overall.
Yeah, I remember this is where the whole segregation story started, right? This was the case because I think this happened in mid-year and just the December prior to that is when SEBI had first introduced the side pocket guidelines. So Tata was the only guys who had it. Okay, Reliance Capital.
Reliance Capital is again one of the companies which has exposure. Of course, other schemes also have exposure, but the 2 schemes which have been side-pocketed for this company are the Nippon equity hybrid and equity savings. Now, Sumera, again here, I think there are multiple cases against this particular house, and currently the debts recovery tribunal, the suit is going on, and there have been advisors who have been nominated, who will be taking the company through the whole of the monetization process. But again, because of the multiple cases on the company, the process has been going on in a very sluggish way. So part payments can definitely come back, but I think it's going to take some more time, and investors will have to wait. And Reliance has already, kept it at 25% of the face value.
So far, Prableen, it seems only Voda Idea is where one can actually, have some concrete hope. Finally, one more, Altico Capital, which, not a lot of people had heard of until we heard of the default.
Yeah, actually, Sumira, it's kind of almost done because they had a lot of the lenders were SBI and UTIMF and Reliance MF, now Nippon and Bank of Baroda and Yes Bank. And all of them, they had created a committee which actually got, which kind of called bidders, that whosoever comes and wants to buy the company. So they went with a Hong Kong-based company, which was SSG Capital. And this company has been able to recover about 71% of the outstanding dues on Altico. And UTI-MF and Nippon MF, which have exposures to this, have recovered about 67% each of their exposures. And it has been paid back to the investors. And I think that's all that they're going to get. I think they'll have to take a hit for the remaining 33% because I think the process is now closed of repayment here.
All right, Prableen, thank you very much for the extensive research that you have undertaken to bring us this quick summary of the status of the segregated portfolio. So, viewers, once again, important to actually go through the investments that your, debt scheme is making, because you don't want to have to hear about it when you hear of it defaulting, right? So, look at it in advance. With that, we're going to take a very, very quick break. On the other side, we're going to talk directly to DIY investors and the things that they need to be checking. We'll have Mohit Gang, CEO and co-founder of Moneyfront, joining in on the other side. Hi, welcome back. You're watching MF Corner. I'd now like to invite Mohit Gang, CEO and co-founder of Moneyfront, to talk about some of the issues that DIY investors are facing. Hi, Mohit. Thanks very much for joining in. So, somebody on Twitter actually just reached out to me saying that they were on one of these new fintech platforms and they were surprised that they were being offered only regular plans, for mutual funds and not the direct plans, which is what which is the whole objective of direct plan, right? Is for DIY investors. So how can investors know before they actually make the commitment whether they're getting into regular plans or direct plans?
Hi, Sumaira. Good afternoon. It's always a pleasure to be on your show. So look, I think as you rightly pointed out, DIY investing is when an investor himself or herself wants to go out on a digital platform and do things or handle his or her investments by themselves. Basically, they want to take complete control. And typically the benefit of such a thing is that it offers an endless, seamless execution, right from evaluating the schemes to execution to monitoring, basically. Now, the point which you brought out is very, very relevant. If your platform is only offering you regular plans, then the whole objective of going digital and not going through a distributor or an intermediary kind of gets defeated. There could be other benefits though, and we can argue about it. But the prime objective is to be able to invest in direct plans. Now, how could one distinguish between whether a platform is offering you regular plans or direct plans? Number one, and very, very simple, every scheme which you buy, which is a direct plan, will have the word direct in it. It's a very categorical requirement from SEBI that scheme which is direct plan will have to carry the word direct. Unlike the regular plan schemes will not have any word. So let's say, just for an example's sake, if it's a fund called, let's say, HDFC Equity Fund or HDFC Flexi Cap Fund, In regular plan, the name will be HDFC Flexi Cap Fund Growth Option, but in direct plans, the name will be HDFC Flexi Cap Fund Direct Plan Growth Option. So you will have a very clear understanding just from the name itself. That's the most important part. The second important way of looking at it is you check the expense ratio of the scheme. So most of these platforms will also show you the expense ratio of the scheme. If you can figure out, and you can go to an independent third party website or the fund house's fact sheet or website and check the expense ratio, a direct plan expense ratio will always be much lesser than the regular plan expense ratio. And that's the second way of tracking it. And the third way, which is a slightly more cumbersome way, is to check whether the platform has a SEBI RIA license or a SEBI registration number, basically, which is like INA or INZ, a 12 character kind of an alphanumeric key. So they are supposed to be, or they are actually, these platforms which carry a SEBI RIA license can sell direct plans of mutual funds. Unlike a platform which carries an MFI ARN only, and they don't have a SEBI advisory license, then they are not supposed to be selling direct plans. They can only give you distribution services. And typically those platforms with ARN number or those banks with ARN number will only offer you regular plans. So these are few differences if one could be careful about it.
Okay, so this is a very important thing, and I didn't know this distinction as well between who can offer regular plans and who cannot. So glad to have that clarified. But Mohit, there's a lot of also subconscious messaging that's goading investors to take riskier bets than they would have liked to. So how do DI investors sidestep it when it's a unconscious or subconscious decision, right, that they're making? So how do they knowingly sidestep it?
Look, so I think there are both pros and cons of technology, Sumaira. I think technology gives you that ability to execute swiftly, on the go, research, monitor, do a consolidated reporting, which are many advantages. And that's the reason why a horde of investors are moving towards DIY platform. It's quite quick, easy, seamless. And within fraction of a minute, you can actually go ahead and execute your transactions. And compare that to the old era when you had to actually sit back and fill forms, cut out checks, and do all those manual works. And one error could have actually resulted in a loss of resulted in huge compensation, or could have resulted in a loss of value for you, right? So those advantages are intrinsic, but as you rightly said, those nudges and those soft push which comes with a digital platform, one has to be very, very careful. Now, my 2 bits on that is that try and see whether your platform is offering you everything free of cost, or are they really charging you something. Look, there are no free lunches in financial world, Sumaira. And let's be very honest about it. Even we run a platform and we have to survive for our sake, basically. So we have to charge our clients a fee or a money or some portion of, as you call it, you might call it advisory fee, or you might call it platform fee. There could be different nomenclatures for it. But if the platform is charging something, that means they have a revenue model. But if they're not charging you something, they're giving you absolutely everything free, and they're giving you direct plans also, which means there has to be some other ways and means how the platform is making money. So in that cases, in those particular specific cases, your radar has to actually go up for an investor and try and be more cautious when you're trading in those platforms, basically. And then you have to be a little beware of those soft nudges. So they will keep flashing new NFOs, new IPOs, new offers, funds being sorted just on last 1 year returns. These are all red flags to me, honestly. If you get a lot many nudges around these, if you get a lot many push items or mail communications around these kind of things, then you have to be aware. 1 or 2 is fine. Telling you about what is on offer is fine. But giving you soft nudges and invoking that greed and fear hypothesis to make you purchase something can really be harmful for an investor in long run. So my whole thing is you have to be very, very careful whether a platform has some revenue model, and plus, are they giving you too many nudges around NFOs and few of these latest offerings that typically shows that one is more keen on building AUM and not going by the right process for investments for a particular client and his suitability.
Yeah, eventually, it doesn't matter which show I do, what is the topic of the show, the end result that it boils down to is buyer beware, right? Everything comes down to that in the end. Okay, anything else that DIY investors should watch out for?
Yeah, look, Sumaira, I think some of the basic ground rules of this thing is, and I personally feel that one has to keep his investing and trading pot separate. I've of late been seeing many DIY investing platforms providing trading and broking services also. To my mind, it kind of gives you consolidated reporting, but if you keep the reporting aside, the more harmful part is that investors are then given those soft nudges and pushes, basically where they are more focused on short-term trading and trading strategies. And I've seen many investors actually redeeming from their long-term investment corpuses and trying and moving into short-term stock ideas or taking trading calls or actually moving into derivatives, which can be very harmful for investors in the long run. Look, we have to also understand that most of the audience which is coming on these DIY and digital platforms is the new age millennial audience. They have not actually seen many corrections in their investing life, and these kind of nudges or these kind of digital push actually can lead them to defocus from investing or long-term investing approach and focus more towards the short-term trading strategies. So my two bits out there is to keep your trading and investing separate, keep them as two different accounts if that's possible, and beware of that part. The last part, I think, which is very critical, is to make sure that your platform has a physical channel to speak to. They have some advisors, they have some service channels, because there are a lot many non-financial transactions like change of nomination, change of bank mandates, change of addresses, KYC updations, and all those things. And I see less and less platforms focusing on these minor nuts and bolts. They actually are more keen on giving 2-click, 3-click investing to investors and not focusing on verifying the credentials and making sure that the records are proper with fund houses. So you have to verify that all your records are clearly and updated with all the fund houses in proper manner. And you have to make sure that there is some support channel. There is an RM or an advisor or a service support where you can speak, take ideas about investments, discuss your own portfolio plans. Every individual is unique. And last mile customization is not possible with DIY platforms. But what is possible is that if your platform provides you an RM channel or an advisory channel, then you need to talk to them and take help in building your portfolios. That help might not be very frequent, but if they give you that help, then yes, I think DIY by all means is a better way to invest, because finally they will offer you direct plans and they will give you ease of investing and reporting everything together.
All right, Mohit, thanks very much for once again, highlighting an important issue and an issue that DIY investors, the ones who actually need this kind of support the most, could benefit from. So that's about all we have on MF Corner today. But do remember to email us your queries and we will have it answered through the week with experts. Do stay tuned in. Closing bell will take you through the last hour of trade.